Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Today we're talking about the multifamily market. Please welcome my next guest. It's Dr. Larry Souza. He's Chief Economist and Advisor for Monetarex, and he's also a teacher in San Francisco, a professor. He's also a CRE and a CCIM. We've talked to him before. You're going to enjoy it. Larry, thanks for joining us.
Hey, you're welcome. My pleasure.
We appreciate it. And let us know about the multifamily sector. I mean, you look at all the sectors, you watch them. How do you feel about investing in multifamily sector today compared to the other sectors, the other choices?
Sure. Well, multifamily has always been historically the best performing property sector on a risk-adjusted basis. The other property sectors, office, retail, industrial, are more subjected to the business cycle. But apartment demand comes fundamentally from housing demand, demographics, and jobs. Multifamily also has the comparative advantage of having access to capital. The government-sponsored entities, the GSCs, provide and back a lot of the mortgage finance for apartments. The other property sectors just do not have that kind of financial backing by a government-sponsored entity. So the multifamily sector, even though you've seen a lot of new construction across the United States, there is more housing demand than there is construction. And I would say definitely the coastal markets will continue to outperform, where the interior commodity markets will be more subjected to supply shocks. And that's just the nature of the business, and it's always been like that over the decades.
Okay, so you like the safety, the available financing, and pretty much kind of the security of that multifamily market. People always need a place to live, right?
Yeah, exactly. And if you look at the statistics, I mean, we just ran our fourth quarter report from Monetarex, and over the last year, about $120 billion in private placements went to the multifamily sector. It's the most popular sector of all the asset classes next to office, and most of the capital is being concentrated in the coastal markets. And the multifamily has one of the highest capital commitment rates to those private placements. So you have very strong financial fundamentals. You have housing demand driven by demographics, driven by employment. And if I was to recommend anybody on what your investment strategy would be going forward, would be to focus on the core markets, supply constrained markets. And if you want to play the commodity markets, I would zero in on properties that are opportunistic or value add in and around airports and ports and universities and medical centers, those concentrated growth areas. And that will immunize yourself from a lot of the supply shock and maybe the impending recession, which looks like it may emerge by 2018.
Yeah, and those are good tips, but I got to key in on that, 2018. So
Sure.
How long do you expect these good times to last? Is that when you're suggesting that we may have some issues?
Yeah, absolutely. We have a retroactive tax policy that's going to hit in 2018. A lot of the over-accommodation that you've seen globally and domestically will start to slow down by that time. And if you study political business cycles, you usually do not have a recession during an election year. And it usually the interest rate start to increase by the Federal Reserve a year after, which means that's 2017. And then the transmission effect of those rising interest rate environments usually hit the following year. So I'm forecasting a slowdown or a mild recession by 2018.
So does that mean if you own multifamily properties, you may want to look at considering selling some of those in the next year or two?
I would maybe sell, hold on to cash. If you sell and you have zeroed out basis and very high appreciation rates, I would probably go through the property and see if there's any deferred maintenance. Maybe you can reposition it, remodel it, redevelop it, try to put some lipstick, on these properties to make them appealing so that when the recession does hit, that your property stands out as a quality asset and people want to live there, and you'll be able to maintain higher economic occupancies and higher rental revenue if you're able to maintain and make sure your property continues to be competitive within the submarket. So I would probably be making capital commitments into my existing properties in preparation for the downturn.
Okay. And like you said, there's a lot of money going into multifamily, and some of that is foreign investment. And there's been some changes with the FIRPTA rules, which may allow more foreign investors the capability to have good returns here in commercial real estate. How do you think these changes could impact the multifamily industry?
Sure. Obviously the domestic capital commitments, are the biggest portion. Foreign debt does have an effect. A lot of the Chinese buyers that I've been working with here in the Bay Area are really looking to build and buy very high quality assets. They're looking for assets in the best markets. They are price sensitive. They're willing to do their due diligence, but I think there's going to continue to be foreign capital coming in. They're going to go into apartments because Brazil's in a recession, Argentina's in a recession, Europe's slowly recovering, Japan's in a recession, and China's decelerating significantly. And we are seeing capital outflows out of China, and they're coming here and they're going into real estate, and they do like apartments.
Well, that's interesting. So your suggestions are a lot of things that could impact the values of commercial real estate and multifamily, what we're talking about today. And one of those factors, I guess, is the chance of rising interest rates. What do you think the impact will be there for multifamily?
Sure. I think overall, unless interest rates rise significantly, the 10-year Treasury is around 2% right now. In 2006 and 7, which was the last recovery peak in the business cycle, the 10-year Treasury went to 4%. I don't see the interest rates going above 4%. So the 10-year will probably go to 3 if it goes to 4. I still think that because of the GSEs and the financing that they provide, it's going to hold down the cost of capital and hold down mortgage debt financing costs for apartments, which has always given apartments a comparative advantage against the other property sectors. Their cost of capital is a lot higher on the debt and equity side. Apartments have always been lower, which gives you a wider spread between the cost of capital and your cap rate or your internal rate of return. So it has a comparative advantage over all of the asset classes, and that's my favorite asset class is apartments.
Yeah, and before we have to let you go and get back to your students, and one I think cracked open a beer. You better watch him back there.
That's not all they're cracking out here.
What are some opportunities in multifamily right now?
Sure. I'm a big believer in employment concentration. Where are the major employment hubs, and where are the supply constrained markets? I think the Western region, if you look at all the rankings by economic occupancy or rent growth or fundamentals, they're in the Western region. Seattle is a great market. Downtown, East Side, a lot of tech. Portland's an okay market. I'm not a big fan of it unless I'm in Washington County next to Intel. The San Francisco Bay Area is severely undersupplied in regards to housing. The big risk here is a deceleration in tech and maybe some layoffs that are starting to form. LA is a big market. If you could pick your markets in LA, extremely supply constrained, a great market. I actually like Salt Lake City if you can get next to the Med Center or the university or the airport. That's a great market it's commodity based, but you can immunize yourself. Scottsdale, Phoenix, maybe by the airport. But be careful, that market gets oversupplied. It provides you with higher cap rates, but again, you could get hit pretty hard by the supply. And then Texas is wide open, and so is the South. Good luck going there. There's opportunities, but you really have to be careful.
Great. Larry, thanks for joining us. We appreciate your insight.
You're welcome. Go to our website and check out our data. Thank you.
We'll do it, and we'll have their website on our show website at commercialrealestateshow.com. Well, stay tuned. We'll have more on the multifamily market. I'm Michael Bull. This is the Commercial Real Estate Show. Stay with us. We'll be
Thanks,
right
Michael.
back. Thank you. The Commercial Real Estate Show is brought to you by Bull Realty, a great place to do business. Xceligent, information for the professionals. And Commercial Search, properties for sale and lease. to access these companies, or for additional videos, podcasts, and articles, visit creshow.com.